The Bank of Canada is currently navigating one of the most complex, turbulent periods in history, with rising debt levels, skyrocketing inflation, and a general sense of economic uncertainty. The challenges are profound, and solutions are anything but simple. But how did we get here? And what does it mean for the average Canadian? Today, we'll break down why Bank of Canada is struggling with what's causing these economic issues and what the future could hold for Canadian economy. At first glance, many might point to the global economic trends or governmental policies to explain their challenges. However, the truth is that the root of the problem is much closer to home. The very structure of Canada's domestic economy is at the core of this crisis. Without addressing these fundamental issues, the path to stability and sustainable growth will remain elusive. So let's take a deep dive into these challenges and what they mean for Canadians. The household debt crisis, a growing concern. One of the most significant issues is the Bank of Canada faces is the skyrocketing level of household debt across the country. Canadians currently owe over 180% of their disposable income, which makes the debt to income ratio in Canada one of the highest in the world. This means for every dollar of disposable income, the average Canadian owes nearly $2 in debt. It's a staggering statistics, and it speaks volume of the precarious state of the nation's finances. This overwhelming level of debt didn't happen overnight. It was fueled in large part of the booming real estate market, a market driven by corporate greed and speculative investment. For years, Canadians watched as housing prices soared to unprecedented levels, creating a frenzy where it seemed like the only way to get ahead was to jump into the market. And jump they did, often taking on excessive debt to afford homes they believed would only increase in value. For a while, it seemed like a winning strategy. The economy was growing, house prices were rising, and many Canadians saw their net worth simply by owning property. But as with economic bubbles, the reality eventually set in. Housing prices have become unsustainable, and with rising interest rates, many Canadians are now finding themselves over their heads. The impact of rising interest rates and inflation. To combat inflation, the Bank of Canada has no choice but to raise interest rates. While this policy is designed to cool down the overheated economy, it has had some serious unintended consequences. When the interest rates rise, borrowing costs increase. This means that millions of Canadians with mortgages, car loans, and credit card debt are now facing higher monthly payments. For the average household, this can be devastating. Imagine you being just bought a home at the height of the market, stretching your budget to make it work. Now with rising interest rates, your mortgage payments have increased dramatically, leaving you scrambling to cover the basics like groceries and utilities and transportation. This is a reality for many Canadians today. Inflation is just another major factor complicating the situation. With prices for everything from food to rising fuel costs, Canadians are finding it harder to stretch their dollars. While rising interest rates may help to curb inflation in the long term, it's creating real short-term pain for millions of people. This begs the question, is raising interest rates the right solution? While it may slow down the inflation, its risks push the household further into financial hardship, potentially leading it to a recession. The Bank of Canada finds itself in a difficult position. Act too slowly and the inflation spirals out of control. Act too aggressively and you risk tanking the economy. It's a delicate balance and one that is providing increasing difficulty to maintain. The real estate sector influence on the economy, another key factor contributing to the Bank of Canada's current struggles, is the country's over-reliance on the real estate sector. In recent years, real estate has become one of the primary drivers of economic growth in Canada. The boom in property prices creates a sense of economic prosperity, with many Canadians seeing their wealth increase simply by owning a home. However, this reliance on real estate has created a fragile economic system. When housing prices are rising, the economy looks strong. But when the real estate market cools down, ripple effects can be affected across the entire economy. Construction slows, jobs are lost, consumer spending often driven by the perceived wealth effect of the rising home values decline. The Canadian economy is now feeling the effects of cooling real estate market, with fewer buyers entering the market due to higher interest rates and stricter lending rules. The demand for homes has decreased. This slowdown in the housing market has far reaching implications. It affects construction jobs, real estate professionals, and industries that rely on a housing market, such as home improvement stores and furniture retailers. Corporate responsibility and wage stagnation, while household debt and rising interest rates are significant challenges. They are not the only issue at play. Another critical factor is wage stagnation. For many years, wages for Canadian workers have failed to keep up with the rising cost of living. This created a situation where many people are working harder than before, but still struggle to make ends meet. Compounding this issue is the behavior of corporations. In an effort to cut costs and maximizing profits, many companies have turned to cheaper labor, often bringing workers from abroad at lower wages. While this may be good for the bottom line, it's devastating for the Canadian workers who see their wages stagnate or even decrease. For example, many companies are offering wages as low as $15 per hour for jobs that require much more to live comfortably. In today's economy, $15 an hour is simply not enough to support a family, especially when the cost of living in major Canadian cities has skyrocketed. If corporations were required to pay fair wages, say $20 per hour for a 40-hour work week, it could significantly improve the quality of life for many workers and reduce the need for multiple jobs just to get by. And maybe then the companies hire Canadian workers. Corporations have a role to play solving Canada's economic challenges. By paying their fair wages and offering more secure employment, they can help reduce income inequality and create a more stable economy. What can the Bank of Canada do to address these challenges? While there are no easy answers, several steps could be taken to improve the situation. Re-evaluating interest rate policies. Rising interest rates is traditionally a method of controlling inflation. It may be time for the Bank of Canada to explore alternate strategies. Policies that focus on addressing specific inflationary pressures, such as a supply chain disruption, could be more effective without putting as much strain on the borrowers. Addressing household debt. The government could implement programs to help households reduce their debt levels. For example, offering incentives for refinancing at a lower interest rate or creating financial literacy programs aimed to helping Canadians manage their debt more effectively could be beneficial. Diversifying the economy. Canada needs to move away from its over-reliance on this real estate sector. Investing in other industries such as technology, manufacturing, or green energy could create new opportunities for economic growth and reduce the risks associated with the housing market turndown. Corporate accountability. Corporations must play a more active role in supporting the Canadian economy. By offering fair wages and better working conditions, they can help reduce the strain on workers and contribute more balance. And what's the path forward? Can Canada avoid a crisis? As we look to the future, it's clear that the challenges facing the Bank of Canada are substantial. Household debt, inflation, wages, stagnation, and other over-reliance on real estate sector all contribute to the current economic uncertainty. However, with thoughtful planning and cooperation between government, businesses, and public, Canada can navigate these challenges and emerge stronger. The road ahead won't be easy, but it's not impossible. The key will be to take a long-term approach to economic stability, one that focuses on addressing the root cause of these issues rather than relying on short-term fixes. With re-evaluating interest rate policies, encouraging corporate responsibility, or diversifying the economy, some steps can be taken to put Canada back on path to sustainable growth. The question now is, will the necessary changes be made in time to avoid a larger economic crisis? Only time will tell, But one thing is certain: action is needed now if we are to avoid more significant financial challenges down the road. Don't forget to subscribe to my channel for more videos like real estate and money. I'm Kevin Baldwin with eXp Realty from Calgary, and remember to stay informed and make smarter choices.